We get to make funny faces.
Oh, are we live?
Yeah, we're live.
This is actually my first live broadcast.
Really?
Ever.
Up here. Thanks for doing it here.
Ever. I didn't want to bring it up until it was actually recording because now I feel like it's real. I'm excited.
It is real. Hi, everybody. I'm Paul Redham with the Homesville Realty Group at Compass, and I'm joined here with Alejandro Juarez, who's a mortgage expert. Mm-hmm. And we brought him on because, you know, we get a lot of questions about mortgages, and I kind of know stuff, but I thought it'd be nice to bring an expert along.
Thank you, Paul. I appreciate it.
You know, since we got rid of our original HUD statements and now we've moved to the Alta statements or whatever, I have been a little bit in the dark about, you know, it's not my old HUD statement.
Right, exactly. The old school HUD statement was one that I got when I purchased my first home. And actually the reason that I began to train this class, what we're going to talk about, closing disclosures and estimates, was because of that HUD disclosure. When I purchased my home, I didn't know what I was doing. I didn't know anything about mortgage.
Right.
And I went to a bank. They gave me a mortgage. For all intents and purposes, I thought it went well. Closed, signed, and was done with it. And years later, I became a loan officer, and then I thought to myself, I wonder what they did for my mortgage.
You went back and looked.
So I went back and looked, and I was really honestly kind of upset because I thought to myself, why didn't they do this? Why didn't they tell me about this? Why didn't they add this to it? All of these things that I should have been educated about that I wasn't, and it was really frustrating for me. So I put together this class. I've been teaching it for a couple of years, and for me, it's really just about educating our clients.
That's wonderful. So you have this mission of don't let anybody else get screwed with mortgages.
Pretty much.
That kind of happened to me.
Pretty much, yeah.
That's cool.
That's exactly right.
I like it when people have a mission.
That's what it's been, and I feel like we train a lot of different types of classes. Yep. This one, without a doubt, has been the most popular one because it is the end all. I mean, it is talking about everything that is going to, you know, turn out in the wash when you're done with your mortgage, when you're done and ready to sign.
That's really cool. Well, we have a limited amount of time, so let's let it rip.
Okay. Yeah. Well, the first thing I want to talk about is just bringing up the fact that when you're in the process of purchasing a home, you're going to get so much information, an overload of information. And when we're talking about closing disclosures and estimates, there are some things that you need to know. The first of which is that you're going to get different formats of these estimates. And they're broken down into, you know, essentially 4 different types. You're going to get a worksheet, you're going to get the official loan estimate, you're going to get preliminary disclosures, and then you're going to get your final closing disclosure. And that final closing disclosure is the actual amount that you're going to pay on closing day. It has all of the exact figures. They are done. That's what you're going to sign on the dotted line for. But it's a long process before you get there. And the first of those is the worksheet. And the reason that this is important, and I always try to remind my clients, is that the worksheet that gets sent out is very rough. And there isn't a lot of in the way of compliance to hold people accountable for what those worksheets say.
So the worksheet's like cocktail napkin math.
Pretty much.
Like, let's take a look at this from 20,000 feet up.
That's exactly right. So you'll have clients that will get a lot of worksheets and they're making decisions based off of those worksheets. And that's really what I want to talk about. You definitely should not do that.
Okay. So the worksheet is just a guesstimation from a lender.
It is a guesstimation
with no recourse.
With no real recourse. And in general, that happens during the pre-approval stage, which is fine because at that time there is no property. We're not exactly sure what the home is going to be. Right. So it's normal to get a worksheet. Yeah. What isn't normal is to get a worksheet when you're further on into the process, and that usually doesn't happen. The real important part about those worksheets is to begin to understand that you have the power and the ability to ask the question why. And one of the things that I find clients don't do is to ask about what options they have. The worksheet that we provide, because we do worksheets as well, is based on creating what we think are the 3 most viable options. And we put it on one worksheet side by side by side so that a client can look at what would happen exactly. What happens if I do FHA, conventional, down payment assistance? How does that affect my interest? All of that stuff.
Sure.
But what happens normally is that the worksheets get sent out, and this is your loan. This is what it's going to be.
Yeah.
And a person that has never purchased a home before doesn't realize that they have options, that they have the ability to ask, why am I in this type of loan?
Right. They probably think a lot of times they should just trust you. I mean, that
Right.
happens on our side of the ball too, a little bit, but like.
And ask me
Yeah.
if this sounds about right, but most people will just simply look at one thing, which is, what is the monthly payment? Can I
Right.
afford that? Great, let's do it.
Yeah.
But they don't realize that they have so many other options and
Or
better
they
ways
could have
to
done much better.
Or they could,
Yeah.
or that they could have done.
Yeah. They could have improved on that.
Yeah, and that's really important. The second part is the loan estimate.
Yeah.
The loan estimate is an official, actual legal document that gets sent out to the borrower once we have a contract and once this contract is
So
official.
that's what I see at the end of the day, the loan estimate on that people are held accountable to.
Correct, exactly. And that loan estimate is really important because it starts showing you a little bit more of the reality that you should expect from that mortgage option and from that lender.
Yeah.
The one thing about loan estimates that's tricky is that there are certain elements of that loan estimate that lenders will be held accountable for, and certain elements that you can continue to change throughout the process.
Really?
And one of the first things that you want to take into account is on that loan estimate, it'll say on the top right corner, it'll say that whether or not the rate has been locked. And in general, at the loan estimate stage, it hasn't been. And so the lender has the opportunity to change that rate lock at any time because there is not a rate lock yet for that particular.
You're not locked.
You're not locked yet. That's really important because you want to make sure that when you're making a comparison, if you happen to be shopping your rate and you're looking at different lenders, what is that lender, where is that lender currently compared to this other lender?
Compared to the other. So that's the time to shop.
That's the time to
get
shop.
loan estimates and shop with those.
And I'm glad you brought that up because a lot of people make the mistake of shopping at the pre-approval stage.
Yeah.
Before there's even a house.
Yeah. I try to get people to wait until they're, in the saddle with the house before they start really committing.
You have to, because at the pre-approval stage, nothing has happened yet.
Yeah.
And what I do with my worksheets and all of the estimates that we provide, we send an overestimate.
Yeah.
I always tell my clients that I'm assuming that anything that can happen wrong is going to happen wrong.
That's great.
And as we start finding out that these things don't and will not occur, we start removing fees so that what they end up with is better than what they started.
Well, that's wonderful. That's really following the rule of expectations and making clients happy.
Setting expectations is the most important. I honestly, and this isn't a plug or anything, I cannot remember the last time that I provided a loan estimate where the final came in higher than the estimate itself.
That's really wonderful.
And I take a lot of pride in that because I want my clients to be able to rest assured knowing that we've accounted for all of those things and that they're not going to get to the closing table and all of a sudden have to pay, a few $1,000s more for surprises.
Sure.
But yes, so with the loan estimate, it's important to compare and at that stage start looking at, well, what does this lender offer compared to this other lender? After that, you'll get a preliminary disclosure sometime before closing, usually about 3 days to plus from closing, which is a little bit closer. Usually by then you're locked. Yeah. We send our CDs 10 days. We send a 10-day prelim CD.
Oh, that's great.
Mm-hmm. And by that point, usually the mortgage structure has been determined and we're good to go. And then the final CD, obviously, 3 days before closing, and all of the numbers are.
That's wonderful because there's always this rush to figure out how much money do I need to bring.
Right, and part of the reason
nobody knows until the last second when titles put it together and you guys have put it together.
So part of the reason we do that is exactly for that reason. We send a prelim CD 10 days before closing, and we send wiring instructions so that the client knows at least this is a roundabout of where we're going to end. And these are the instructions for me to wire or provide the money to the title company. And we always make sure that they confirm with the title company that the wiring instructions are correct. We get our information through a secure portal directly from the title company, so we're not just going based off of emails that are going back. We try to make sure that that's
we avoid fraud that way too.
Of course. I mean, it's a lot of money that's going from one end to the next. I've heard some terrible stories. Luckily, we've never been a part of them, but you want to be really careful about wiring large sums of money, and you want to check with your title company.
People's lives get destroyed. Like not only they can't move into the place they thought they were going to move into, but in many cases they've lost their.
I mean, you have clients that are wiring $100,000+ sometimes for their down payment and closing costs. That's a big chunk of money.
It's a big chunk of change.
And oftentimes it's money that people have been working for their entire lives, and we don't take that lightly. So we want to make sure that everything is being run through our secure portal.
That's good
at all times.
It's really good.
Okay, so the next thing I want to talk about, obviously we have those 4 items. We have the worksheets, the loan estimates, the preliminary disclosures, and the final disclosures. Given the amount of time that we have, I want to kind of fast forward to some of the things that clients can look out for in terms of protecting themselves.
Sure.
And this is actually all of why I've put together this class. And the class in general is about an hour and a half long. We're condensing it to about 20 minutes.
And here comes the meat, guys.
Here comes the
meat.
meat.
Pay attention.
A couple of things that I think and that are really bothersome to me about this industry. There are a lot of people out there that will do everything they can to take care of their clients and to guide them to make good decisions. Everything that we do in our branch is about honesty, integrity, and accountability.
That's beautiful.
Preparing our clients and making sure that they have the information necessary to make educated decisions about their future. But it is really frustrating because sometimes, we might get an estimate from someone else where they say, hey, look, this is what they're offering.
Right, when you're shopping.
A great example is of one that I wish I could show it to you, but of one that I got recently, and they're saying, hey, well, you're saying that we're at a certain rate, and they're saying we're at this rate.
Right.
And I started looking through the estimate that they got, and I realized that they're getting a great rate.
Right.
But they're paying $7,000.
But their costs are way high.
But they're paying $7,000 to buy that rate down.
Yeah.
And there's nothing wrong with that. There are strategies to purchase a home, and that could be a strategy. Yeah. But there's a difference between openly understanding what the strategy is and hiding things in the numbers.
Yeah, people need to know where you're making the money.
Exactly.
I found it's either on rate or it's on origination fees or whatever, right?
Yeah, exactly. Yeah. And one of the most important things about mortgage, I try to tell everyone that they're just simply, maybe I'll get in trouble for this, but there's no mortgage company on the planet that makes money off of giving money away for free.
Yeah, it doesn't work.
It doesn't work that way.
No.
And there are a lot of really great programs. There are 0% down programs. There are programs that do really low down payment assistance programs, really low closing costs. They give you all of this cash. All of those are strategies. And if you understand what the strategy is and how it works, then brilliant.
Yeah.
But if you don't, or people are using these marketing terms to nab you and not explain, I just don't think that is.
Let's take advantage of the consumer.
Of course.
Let's face it, like we all want you to be able to feed your family,
right.
Take care of life, and buy a car and do all the things you need to do. But like understanding what we're getting into, I think is key, and that's beautiful.
And you can do it right, and you can break down these options for them and allow them to understand.
It's transparency.
When you get an estimate or a closing disclosure, there are a couple of things that I look for immediately to find out where the mind is of this lender and how they're preparing this loan estimate. Yeah. The first thing that always comes to mind is the days of interest. The days of interest that lender is estimating that client is going to pay. Mm-hmm. To me, that is a dead giveaway of their mindset. Because as a loan officer, if I don't have a contract and I have no idea when this closing is going to be, let's say the client is shopping before the contract comes in and they want to make up their mind before they even go under contract, because that does happen.
Right.
We might get a loan estimate, and that estimate shows that lender is charging just 1 day of interest, right?
Oh, gosh.
So that to me is very disingenuous, because there's no way for anyone to know at that stage when you're going to close.
That's not setting expectations very well. Yeah, our cat is requested to be. There you go, guys. Yeah.
And so to me, that's really disingenuous, because what we're trying to do is prepare our clients. We're not trying to shave as much money off of this disclosure as possible. Right. We're trying to show them, like, this is where it could legitimately fall.
Well, that saves you so many headaches going down the road. Like at the time when you make that worksheet, it's probably about winning, but like down the road, you got to explain, hey, the interest, days of interest.
If you're closing on the first of the month, you're going to collect 30, 31 days. If you're closing at the end of the month on the last day, we might only collect one. But at a stage in which we don't know, I just simply always do 15 days, and I go from there. That's something that won't necessarily tell you a lot. Maybe they're charging you 14 days more when it ended up, finding out what the closing date was. But it does give you an idea of where that person's frame of mind is, because sometimes what they're trying to do is take away as much money as they can.
It's really interesting
to make it look like it's going to be better than it is. So that's one for me.
It's a quick way to see where these people are at.
Because if I'm sending a loan disclosure, a loan estimate that's saying, we're collecting 20, 30 days or 15 days, then my closing costs are higher.
Right.
So someone could say, well, hey, our costs are lower.
Yeah, then you have to explain it. So
Right.
It's really about education.
It's really just about education. The second one is unexplained rate buy downs.
Well, hold on. Let's go back to this closing date thing
Sure.
and days of interest. What I've always told people is, hey, there's just no free ride. It doesn't really matter where we end up in the month closing. You're either going to pay interest, you're going to pay it there at closing.
Correct.
Is that true?
That is.
I got that right?
Absolutely.
Okay.
I mean, if you're essentially, what I try to remind my clients is that they are going to pay somewhere around a month and a half, or they're not going to make a payment for about a month and a half.
Right.
And in general, how it works is if you're closing whatever day in the month, let's say you're closing September 15th, then you're going to pay interest for September 15th all the way through to the end of the month.
To the 30th, so we can start.
Exactly. On October, you won't make a mortgage payment. You'll pay your first mortgage in November for October because your payments are in arrears. Exactly.
So I have to borrow the money before I can pay interest.
Correct. You're
right?
essentially paying interest for the month of September because you're not making a mortgage payment in September.
Which explains, and I had to go through this morning, why interest is on our payoffs. When we go to sell,
yes, exactly right.
It's always more than what you see on your statement.
You have to get a true payoff because what you see on your statement is not including all of that interest.
Yeah, that's
absolutely
really cool.
right. Yeah. So that's really important to me, is the days of interest, only because it gives me an insight to where that lender's mind is, what they're trying to do, and how they operate. Because I the moment I see that, I bring it up because I just think it's one of those really disingenuous things.
It's telling, right? So I'm going to quote 1%, 1 days of interest.
Right.
If I really want the deal, I don't want to show my costs low.
Right. Exactly.
But I'm gonna do 15 if I want to be fair to the possibilities on either side and explain that.
Right, exactly. And if you wanted to be really, really conservative, I suppose you could put 30 or 31 days, but I think 15 is fair enough. It's in the middle. We don't know yet, and we'll find out once we have a contract.
Yeah, I don't want to upset Chris Voss, but like that's splitting the difference.
Yeah, exactly.
That's pretty cool in this case, I think.
Exactly. So the next thing would be unexplained rate buy downs. And this comes on your loan estimate and also on worksheets. It should be listed. And this is the famous in my mind, the waving kind of golden carrot. You know, it's getting your mind somewhere else when something else is happening at the same time.
Oh, it's a little
hocus pocus.
Switch and bait or
whatever. It's sort
of.
I mean, there's a fine line because it's not necessarily illegal or against compliance. Again, it's just telling about the way that lenders do business.
Unexplained rate buy down.
Right. And so the way that this works is when I send a loan estimate or when I quote rate to my clients, I'm quoting them the honest rate. I'm quoting them what the rate is without me buying down their rate or charging them additional, points to buy down their rate.
Right.
I'm just telling you, this is what is your par rate, which essentially means your free rate. It's free to you, free to us. We're not going to charge you for it. So I could potentially say to someone, hey, your rate is 3.75. Let's just
depends on their hot button, right? Like,
for sure.
So if somebody's hot, if I'm an unscrupulous lender, I might identify rates a very important thing. So we bring up the closing costs a little bit, right?
Sure.
And if closing costs are a hot button, then you flip that.
You flip it, to some degree. I would say that they're
not you,
definitely.
But
and it just depends on this. Again, the strategy. And for me, it's just about disclosing this to your clients so that they know what's happening. If I were to say to a client that the rate is 3.5 or 3.75, but they really, really want it to be 2 point something or 3 or whatever, then I would just simply tell them, listen, we can get there, but this is what it's going to cost you.
We can do that, but it's expensive.
Exactly. Whereas what you see a lot with different types of transactions from people that are willing to take advantage of others. I see it a lot in builder deals, if I'm being honest. And what happens is that the first time home buyers don't have the experience to understand where to look. And I have a client right now who was given a 3.75, something like that. And they were really excited about it, and they thought, that's pretty decent, not bad. And come to realize they are being charged about $7,000 to buy down the rate to that point. So their true rate, their par rate, is really 4.5, 4.625, but they had no idea.
That's really frustrating.
They didn't have any clue. But the waving or the carrot here is that in that situation, the sale is we're going to give you $7,000 worth of closing costs to go towards your closing.
So, yeah.
Never mind the fact that I'm charging you $7,000 just to get your rate to a respectable place.
Right.
So it essentially just cancels itself out.
It's even.
It's even.
But like you have a lot of people get their, in the lending business, from what I understand,
Mm-hmm.
at banks and at builders, that's where people get their teeth cut.
Right, exactly.
Yeah.
And to me, in those situations, there's nothing wrong with that so long as the client understands what is happening and that you've sat down with them and said, look, this is the strategy that we're going to use for whatever reason. But in this situation and in many situations I've encountered, that isn't the case. The clients are surprised. They have no idea that that's even something that can be done.
Well, I don't know that those lenders, either at the banks and with the builders that are getting paid less and all this stuff, even understand that. I don't feel like they've had enough experience.
Yeah, it would be difficult for me to comment on why or how they do those things. It's hard for me to imagine that they don't know that they're doing that, but I suppose that is possible. I mean, it is. It's just one of those things that the moment you get your loan estimate, you want to find out what your rate is. But on the top left of the first page, or on the top left of the second page, you'll see a section there that's called origination charges. And it'll tell you there in that section how much you're paying the company for the business of the mortgage, of closing the mortgage, and it'll also include origination charges and rate buy downs. So if you see a large number there, you should know automatically that that rate that you're being offered is contingent on you also paying this.
I wish they put it on that form as a seesaw.
It'd be nice. That'd be cool. I mean, I know a lot of people are not big fans of the new CD that goes out.
Yeah.
And there's a lot of contention about whether that should be the form that we use, but that is the form that legally we're bound to use. So we just try to do the best that we can to explain how it works. In a simple way, if you're right now in the middle of a closing and you're going to close your home in the next week or two, or you've got a final CD, I would tell you this. Look at that final CD, and it's really simple. Page 1, page 2, and page 3 are the most important. Page 1 is a general summary. It's a general summary of everything that's happening with your mortgage. The monthly payment, the amount of interest that you're paying, whether or not the interest is fixed rate or variable, how much your escrow account is going to be, and at the very bottom it has what your closing costs are for that closing. That's page 1. Page 2 should be an itemized breakdown of all of your fees. Everything that is being charged on the loan in general is going to be on page 2. So the loan costs from the lender, origination points, mortgage insurance, escrow account, all of those things should be there on page 2, and they tally it all up. And page 3 in general has another summary of the original loan estimate that they gave you in comparison to the final CD. And you'll also see on the left-hand portion of that this closing disclosure, you will see things like credits from the seller, credits from any place that were necessary. If you've got prorations for taxes, all of those credits will be on page 3. So if you think about it that way, it might be a little bit easier for you to break down that final CD. General summary, itemization of fees, and then a summary of all of your credits that you're getting back.
And that's where they would make any adjustments if they needed to by law.
Sure. Right. If they needed to make adjustments for, let's say sometimes things come in last minute where there might be an amendment, or there might be a lease back, or there might be additional costs for a warranty. They would usually put that on page 3 and say that the credit is being accounted for in the closing. I know that closing disclosure can be really, really confusing. That's why when I talk to my clients, I tell them, this is the loan estimate. This is the worksheet I'm giving you. I want you to hold on to it. I give them a hard copy, and I tell them, I want you to use this to keep me accountable to what I promised you.
That's wonderful.
So that when your final CD is out, I'm going to call you. We're going to go over that final CD together, and we're going to compare it to what I promised you. And that way, the client at that stage, they understand that we're doing things right. We're not trying to surprise them.
Yeah, there's no Slick Willie here.
I tell people, I'm an open book. I mean, you're going to ask me a question. I'm going to give you an honest answer. It might not be the answer you want.
It's okay. It's a reality. It's the truth.
Exactly.
You got to run with the truth every time.
Yeah, and it is it is definitely a much broader conversation than what we've condensed it to, for sure. But as long as I think the general summary of this conversation is, as long as you feel like you're in a place where you're comfortable enough to ask questions about why you were put in that certain mortgage, why certain things are this way on your closing disclosure, ask those questions. Don't be afraid to hold people to task and hold people accountable and protect yourself, because at the end of the day, your lender should be your number one friend. That person should be helping you make decisions that are in your best interest in the short term, in the long term, whatever the case is. Don't be afraid to ask.
That's exactly right. Asking like what your options are, I
think options are the most important thing. I didn't get any when I purchased my first home. 0 options. It was, here's your mortgage.
Here's the deal.
And I looked at it and I thought, that works. I could do that per month. And I signed it.
Well, I hate to say it, but I'm glad that happened to you, because clearly it lit a fire.
It did.
And now you're going to save people. Thank you so much.
You're very welcome. Thank you all
live. And,
I hope this was helpful.
I suspect it was. And before we go, where are rates today, and what do you see coming?
Well, there should be an announcement today, I think around 2 o'clock, for what the Fed plans to do with rate cuts. And in terms of compliance, I don't know that I'm allowed to state a specific rate, so I'm going to keep that.
You think it'll go down or up or stay the same?
Everything right now seems to say that it's going to go down.
Yeah.
Now, in general, that doesn't necessarily directly
Fed,
impact
right?
the mortgage rate, but people make decisions based off of those announcements that ultimately affect what occur with rates. Rates are fantastically low right now. That's what I can say.
That's just really beautiful. And they're going to stay that way.
It seems that way. Yeah, we had a little bit of a blip last week where they jumped up for a little bit, but it's still, in general, they're incredibly low. We've been doing a lot of refinances for clients that bought a couple of years ago that were, close to 5, 4.8, 4.7, a year or two ago. And refis are popular right now. For sure.
Well, for good reason. So I keep trying to explain to people sometimes when the Fed lowers their rate that doesn't correlate necessarily with what happens in your world.
Right.
Because tell me if I'm wrong, but like the secondary market, they trade on what they see as inflation. And that's what really drives your side. Right.
And they're, completely different markets, right? We have the stock market, we have second mortgage bond securities market, and they act in general how would you say, opposite to one another. When you see the stock market is booming and people are taking their money and putting it in the stock market, you see a decline in the mortgage bond securities, and rates usually, go up. Right now, there's so much volatility, there's so much uncertainty that rates have improved because of that. But it has also been volatile. So at one moment they're really great, and then we have a really bad day.
Yeah.
If you want to follow what's happening specifically with the mortgage bond securities, you can go to a great website. I want to say it's Mortgage Bond Securities Dashboard, and it'll keep you in tune with what's happening every day, specifically with the mortgage bond securities, so that you can see if you should be locking right now, if you're okay to continue to float. In general, my advice is that if you're under contract and have just recently gone under contract, that in this market with all of the volatility, you should probably lock as quickly as you can, because it's very hard to predict what is going to happen tomorrow or the day after. It is very volatile.
And if you lock, I assume you can float down.
So in certain cases, you can the floating down thing is really complicated, because in certain cases when you've locked and let's say the market improves like a gigantic amount, what you can do a lot of times is split the difference with your lender.
Really?
Right? Because let's say it improves where you could go from 4.5 to 4.375. Well, there's not a 4.45 in between there somewhere. So there has to be enough of an improvement where there can be a split of the difference. But I always tell clients that the lock is there for a reason. Right, you are essentially saying to yourself that you want to curb the risk out of this, out of this equation. Yeah. So when you're locking, for all intents and purposes, you're locking your rate based off of that specific day. So you have to be really certain that you want to lock your rate. I've had it happen a lot where that exact scenario happens with clients, where you lock and then the mortgage, bond securities improve drastically. Yeah. But I've also have it happen the other way, where we've locked and the floor falls out, and they're just so happy about the fact that we locked. And so it's always kind of a double-edged sword when that happens with clients. I always remind them that you know, if it would have gone the other direction,
Yeah.
you would have been really, really happy about doing that. And so locking is very, very complicated. But right now in this particular market, I would tell people to lock as quickly as they can, because it's already so low. You've already won. Sometimes I kind of bring up the example of kind of like winning the lottery.
Yeah.
People will win the lottery and then they'll say, well, where am I going to invest this money? You already won the money. Like you won the lottery. Like there's no, just be happy with it.
Yeah.
And so in this situation, rates are incredibly, incredibly low. I would say lock, protect yourself, and then, you know, go from there. There are other people that are willing to gamble a little bit more. You know, my wife is from Vegas, so she might be one of those people that says, hey, let's float it and let's see what happens. And they're okay with that. That's fine. But in general, most clients want to just secure what they have.
Well, very cool. Well, thank you so much. I think we could go on all day.
We could.
I really appreciate
Absolutely,
you being
especially
here.
me.
And thank you guys for paying attention. And Alejandro is available to you to ask questions and figure out loan stuff.
You know? Yeah. If you have any questions, feel free to reach me at alejandrojuarez.com. You can reach us, check out videos, trainings, all of that stuff on my website. Thank you all.
Very cool. Adios. We're still live.
We're still live.
This is the fun outtake part.
This is what they do in news stations whenever the reporters start talking to themselves, but you can't hear it.
It's to me the funnest part.
Yeah.
Like
putting voices.
What are they really saying?
Putting voices on there.
Yeah. There we go.
Bye, everybody.